All right, guys. Hopefully this works out. I have everything on here right. What's up? I'm gonna do a quick little video, and I'll do these periodically where I think I could add some value and things. But I wanted to talk about the put walls, and I got some questions on the put walls and how we use them. We trade. What I was talking about and tweeting about today. First off, where do I get the levels? Is one of them. So every day on Twitter, X, whatever you want to call it, I put out the levels on Twitter. So if you come down here on my profile, and you're gonna see it look like this somewhere right here. So it may look like it's the wrong date, but it's not the wrong date. It's just that the cache on it has not been updated. It is the correct date as long as it's been posted the same day. So it's on here, and it'll look like this. You come in, and you'll have the option levels in here. I kind of first day ever I goof up. This says 435. The put wall is actually 430, like you can see on my chart right here. I have it. I have it put on here as 430. Also give you the SPX, ES, SPY, Qs, put walls, gamma levels, call walls, etc. And in our room, we go over the different things on why they change and what it means when one indice moves or one ETF moves and the other one doesn't move up and things like that. So the New Age Wall Street room is totally free. There's a link somewhere in the timeline if you want to come and hang out with us and trade with us. So this is one way, and then a paid way. This is totally free, by the way. I post this for free every day. Other way is through Spot Gamma or like another service like this. I think the minimum, the basic plan is like $89 or whatever through Spot Gamma. If you want to go through this, they have a lot of other little things in here. But you can see that it's the same, kind of the same way that they have. They have some more other levels that I don't think are as relevant, so I don't necessarily mess with them. But you see where the put wall is 430, right? Now, what exactly is a put wall? What is a call wall, right? So the call wall is the highest concentration of calls through all strikes and all expirations in the option chains. So all the strikes, all the expirations, all of them, the highest concentration of calls. The puts is vice versa. So the highest concentration of puts as far as value, and that is all strikes and all expirations for the puts. So for today on the for the put wall, this is where all the concentration of the puts are, all strikes, all expirations, and where it is today, right? Now the thing is whenever this is more kind of like a mean reversion type strategy. If you open up or we pass below the put wall level, the price is going to want to always go, well, not always. So what I have back tested is about 73.47% of the time it will mean revert to go back above it. And the reason is because all the dealers that are selling that premium, right? So they're selling this 430 premium. They only make money if the price is above this by the end of the day today, right? They don't make. They lose the money if it's below this. So if you have over, let's see, 3,000 contracts right here, and then the rest of this in the money, yeah, or excuse me, it's on the put side. So in the money right here, right? Then you're going to wind up losing all of that notional value, all that value that you wrote those contracts for. So what are you going to do? You're going to go ahead and buy the underlying. You're going to buy the indices. You're going to buy the ETF in order to move the underlying, so that your derivative contracts, your option contracts, do not expire worthless, and or they do expire worthless. Excuse me. So they do expire worthless. So you make money off of the premium, and then you're taking all the money away from the retail traders, right? So as retail traders, most of us are buying the contracts, and we are betting that the price is going to stay or get below the 430. The dealers, market makers, institutions want it to stay above so that they expire worthless, right? So that's exactly what happened today. Is whenever you see that the price is opening up below, or we get below the put wall, we're going to tend to want to always move above it, or at least go and test it. So once we get there, then we have to see if the market is balanced enough in order for us to create a demand to go up. If not, if there's an imbalance and there's more supply, then we'll continue going down. But at least we did go ahead and try then at that point. So Like I said, it's about 73.47% of the time that this happens, and it works the other way too. So if we open up above the call wall, which today the call wall is at 450, if we were to open up above 450 up here and kind of shoot up right at the open, the price will want to come and get back below 450 because the call sellers need the price to stay below here in order to be able to collect their premium, right? Now the call buyers want it to be above that in order for them to make their money by the expiration as well. So the thing is that institutions, dealers, whatever you want to call them, the smart money, they have a whole lot more money to be able to manipulate the market than we do as retail traders, right? And they hardly lose, like I just said. So this is especially prevalent on monthly expiration, quarterly expiration, things like that. On a daily, like today, that's where it kind of gets skewed, and there's a lower amount of time that it happens, and it brings it down to that 73%. Is because it's not as big of value. But if you were to come and you look at for instance, say we go to the quarterlies at the end of the month here, right? And we come and look at the 450, 430 or whatever contracts, you can see we have bigger notional value at 440. We have 11,000 right here. There's a bigger amount for the bigger contract dates, like monthly, quarterly, etc. So I just wanted to kind of make a little bit of a video here for you guys to kind of show you that something that you could add to your toolbox and add some confirmation for you instead of chasing to the downside, because Lord knows everyone all weekend was saying the sky's falling, Chicken Little style, right? The world is coming to an end, 1987, like all over again, and we're going to go straight down. Not today. So at least not today. We do not accept any lower or anything like that. And we have to at least come up and test that supply, and then maybe tomorrow, maybe the next day or what have you, but not right now at this moment. So and this happens quite a bit, and that's what causes those big squeezes when there's a huge imbalance, when too many people are on the short side. You load up the short side, and then we start getting a little bit bullish, right? And then we're having that organic buying along with short covering, and it creates an even bigger move to the upside, right? So so again, it's something to look for, and when everyone is kind of bearish and we're oversold below the put wall, look for that mean reversion back above it and for the price to close back above. Now there are some people that say that price action is random towards the end of the day and you can't trust it, this, that, whatever. I don't believe that's necessarily true, because by the end of the day, that's when the expiration does, the contracts expire, and they need to be at that spot by the certain time. And I have tons of data where XPX closes right at, like, to the penny, to the tick, where it needs to, on big expiration days and things like that. There's never a coincidence in the market. There's never a coincidence. So you tell me here, we moved it back above it. We try to come back below the put wall, right? Blast it off. Then we came in, we tried to get below it. We gave it a little bit of low tap. Hell no, the buyers were sitting here already waiting, and then we rallied into the close. It doesn't look random to me. It looks like they did try to go ahead and protect this 430 level with everything that they had pretty much all day, and that would be a win for the bulls for today. So I hope this helps you out. I know it's a little bit different way of looking at things, and it's assuming, right, on the positioning of the people on the other side, which is a lot of kind of like what we teach you to do in my room. So again, it's free if you want to come trade with us. We'd be happy to have you. Teach you a couple things other than trend lines and other BS things, patterns that other rooms show you. See you guys.